Hi, everyone. Welcome to this week's market update. I'm here with Eric Anderson. Eric, this week's headlines range from rate cuts in Asia to political theatrics in the US. What caught your attention first?
Honestly, it felt like we were watching two movies at once. One a political thriller, the other a quiet economic drama. Let's start with the spectacle. Elon Musk versus Donald Trump. This wasn't your typical Twitter spat. It was a full-on ideological clash, with Musk threatening to launch a movement aimed at tackling America's debt crisis. Now, let's pause there. That might sound like noise, but it's actually something deeper. For one of the world's most influential entrepreneurs to drag the national deficit into the limelight tells you just how mainstream fiscal concerns have become. The U.S. debt load is no longer a background issue for economists and rating agencies. It's front and center, in 280-character salvos. And while Musk and Trump traded jabs, the bond market quietly voted with its feet. Yields dropped again as traders priced in, not one, but two Fed cuts by year-end. Weak jobs data and a soft ISM services number gave the market all the ammo it needed.
That leads us to the Fed. Are markets getting ahead of themselves with rate cut bets?
Look, the data is leaning dovish, no doubt. ADP jobs added just 37,000 in May, the slowest pace in 2 years, and ISM services dipped into contraction for the first time since mid-2024. But I'd still say, not so fast. Yes, the market now sees two cuts as the base case, but the Fed's been crystal clear. They want to see durable disinflation and sustained labor weakness before they move. What we're seeing now is fragility, not freefall. If anything, the Fed will want more confirmation before pulling the trigger. So while rate cuts might be coming, they'll be dragged in, not leaping forward.
Let's shift to India. Surprising move from the RBI this morning.
Totally unexpected. A 50 basis point rate cut was not what the market had priced in. The RBI went bigger than anticipated, but tried to dampen expectations by shifting its stance back to neutral. That's central bank speak for, don't expect a series of cuts. Still, the message is clear. India's prioritizing growth. Inflation's tame, confidence is stable, and policymakers want to keep momentum going, especially with monsoon season ahead and global demand still wobbly. The rupee wobbled a bit on the news, but overall, markets took it in stride. Investors seem to understand this is a calculated easing, not a panic move.
There's a lot happening on the US-China front, too. What's the latest?
This week we got a rare diplomatic détente. President Trump and President Xi held a 90-minute call, their first direct chat since Trump returned to the White House. The optics were surprisingly warm, with mutual state visit invitations and early signs of tariff de-escalation. They agreed on a 90-day reciprocal tariff reduction, U.S. tariffs down from 145% to 30%, and China's down from 125% to 10%. That's huge. It doesn't fix everything, but it signals intent, and that's often what markets care most about. More quietly, China seems to be playing its hand with surgical precision. Its grip on rare earths has given it serious leverage. Ford halted SUV production this month because of magnet shortages. And China's new licensing regime is causing ripple effects across electronics and defense. It's soft power, delivered via supply chain.
Beyond geopolitics, what's your read on China domestically?
Honestly, quietly improving. Consumer sentiment is ticking up. Beijing has rolled out a steady stream of pro-consumption policies. And if that momentum builds, we could see a decent rally in Chinese equities, especially given how depressed valuations are. The CSI index is still subdued, but it's prone to sharp upward spikes when sentiment shifts. And with signs of thawing US-China relations, we could be near one of those inflection points.
Germany's stimulus plan flew under the radar a bit. Worth paying attention to?
Absolutely. Germany's cabinet just signed off on a €46 billion corporate tax relief plan. That's real stimulus, spread over 4 years, and the DAX loved it, hitting record highs this week. It's also emblematic of Europe's broader trajectory: fiscal flexibility, lower inflation, and a central bank that's about to cut rates.
That's it for this week. Stay tuned for more insights next time.